Hello, I'm Emma Wall, and I'm joined today by Crux's Richard Pease to talk about the impact of coronavirus on European equities. Hi, Richard.
Hello.
So, Europe has been the epicenter of the coronavirus crisis, almost in an unforeseen manner, centering particularly on a number of countries. How has what's been going on with the virus impacted European equities?
Well, initially, very, very severely, and that was pretty much a global experience, obviously, and we certainly thought it was going to be more of a SARS type thing rather than a global thing. And so I think we were all taken by surprise. And then I think the market's been able to obviously reevaluate situations. And I think as long as companies are being well funded and can kind of hold their breath through the crisis, I think the market then was able to look ahead. And certainly you've seen the market recovering quite strongly in the last 6 weeks and being a bit more measured.
And for you as an investor, did you see this as an opportunity to add or indeed reshape the portfolio? What did it mean from an investment point of view?
I think when you get extremes of sentiment and volatility, if you can keep your nerve and actually behave rationally, the market will reward you at some stage, hopefully in the reasonably near future. And I think what we try to do is work out what we really believed in and what we really felt was very good value and favoured those stocks. And I think if you had some doubts, in a way, there was no doubt, and you probably took the opportunity to actually swap that for something where you had higher conviction. So we definitely did some of that. I think the temptation is always to go super safe and just go for something very respectable and uncontroversial. I think that tends to be a mistake because it hasn't fallen, it won't bounce, and we felt that the market was very oversold. And so we didn't do it.
And how do you sort out what has been beaten up by sentiment, but the fundamentals continue to be compelling on a medium to long term basis, versus stocks where there may well be a longer term structural change to that sector? I'm thinking in particular of things such as tourism, travel, airlines, where there is some question around their recovery.
I think that's a fair question. I mean, we didn't happen to have any airlines, but we did actually buy into Airbus after it had fallen, but to be fair, not particularly at the bottom. And I think, again, you have to have a very good reason. And our reasons were that it was, from a balance sheet point of view, very robust indeed, with a lot of industrial cash, unlike its main competitor, Boeing, that's leveraged and had issues with obviously Boeing Max. And we actually believe that people will still fly. I think you could argue that it may take 2 or 3 years to get back to where we were last year. I think that's probably fair. I mean, business travel is about 12% of travel, and that may be more selective. But I think to take a bet against people wanting to have a holiday or see their family, I think is a bad bet longer term. And you have got a global champion. And if you kind of believe in the story, and it had something like 10 or 11 billion of industrial cash, with a lot of scope for margin improvement, if we get back to what we got to last year, you can see how it's on a very single-figure multiple with a capital-light business model and a much more shareholder-friendly approach. So those sorts of stories, I think, have been opportunities, but you have to have the patience and the balance sheet, obviously.
And what about certain sectors where there isn't that ray of light at the end of the tunnel? We were talking before we began recording about trends that were already in the market, but this volatility has simply accelerated, like e-commerce, for example.
Yes, I think that's a good point to make. I think bricks and mortar retail, we all kind of know, was having a very tough time. Post this crisis, I'm afraid, if it's possible, it's even worse. So it's accelerated its demise. But we haven't obviously had exposure to bricks and mortar retail. I think people are perhaps trying to reevaluate their approach to having an office. And that's certainly impacted some of the property company valuations. Again, I think we would differentiate between offices and retail. If you've got a lot of retail as a property company, I think it's much tougher. I think, again, it's a personal view, but I think with offices, yes, it'll put some pressure on demand and obviously on rents and valuations. but I don't believe in the end of the office, actually. And I think certainly if you look at some of the discounts that these property companies are now on, we don't have much exposure, but I think there's a perfectly good case as an investment.
Now, we're all very familiar with the UK government's approach to the coronavirus because we're living it. We're still living in lockdown. What's happening in Europe, and how is that impacting the underlying stocks?
Well, I think just on the ground, as it were, Europe is opening up. It's a little bit ahead of us. It was a bit ahead of us into the crisis. It's a bit ahead of us coming out of the crisis. And certainly, Sweden, for example, had a very different approach, as you probably appreciate, which was never to really lock down. And we watched this space. And I think from a sort of stock market point of view, we've seen some quite strong recoveries as we speak now. And stocks which had, in some cases, halved have recovered quite sharply. But they're good long-term businesses. So I think people, it's a fool's game to try and guess exactly what's going to happen next. But I think if you can focus on the quality of a business and its dominance, say, in the market, and make an assumption that we will win against COVID-19, which I'm an optimist and I do believe we will, it would be really odd to knock a stock which wasn't particularly expensive by 50% if it's a sort of 2-year problem, because we try and value things on a sort of 15-year basis, on a 2-year basis. So you can sort of see, once the market gets rational, that stock prices do recover. And I think the other positive, or just a fact of life, is that when we're in a difficult time, like we obviously are, interest rates are not going to go up. So the person with cash, if you do nothing, you get nothing, or less than nothing if you're in parts of Northern Europe.
And how much of what happens globally is impacting what's in the portfolio? Because I know that you look for leaders within their field, which are often international in their outlook, client-based revenues, lots of cash. So presumably, even if Europe begins its recovery, opens up its doors, you're dependent a little bit on the rest of the world getting up to that level as well.
Yeah, that's true. And I think at the moment we obviously have the added complication of China and the US and all the kind of trade wars that we've been talking about before, but in a way sort of souped up a bit because of what's happened. And that's certainly, being cynical about it, a problem until the November election in the US, where I think perhaps, hopefully, it'll be less sort of emotional in terms of how it's put. So we do worry about those sorts of macro factors, but I think at the end of the day, it's always about picking a company which can handle trouble, and in some cases benefit from the volatility. Because I think it's easier. One of our sort of basic sort of approaches is to buy into businesses which can actually augment their growth by inexpensive bolt-ons, and it's probably easier to do it in a difficult time than when everyone wants it and private equity has got too much money to spend. And so I think again, if you can keep calm in these situations, you can actually plant the seeds for some very good long-term opportunities.
Richard, thank you very much.
Thank you.